start with the first session under the blended finance track, Demystifying Outcome-Based Financing, Reflection from Donors, Real-World Experience. As a few of us might already know, outcome-based financing, OBF as we all call it, has been gaining traction as a transformative approach in the development finance space. However, many questions remain about how more donors and investors can engage and what benefit it offers for them. Today we'll explore the concept of OBF and how it can be applied to various priorities within the regulatory boundaries. The session aims to shed light on the merits and challenges and address common misconceptions surrounding around the OBF. We'll discuss how different pools of capital and competencies can work together to maximize impact. I would now like to invite Anushri Parekh, Associate Director at Associate Director Social Finance at the British Asian Trust. Anushri will set the context and with a short presentation and lead the discussion. Over to you, Anushri.
Good afternoon, everyone. Thanks Varun. Thanks IIC for creating this platform and bringing us all together. Thank you, Prachi, for that very kind introduction. The good thing about following people like Prachi, who are kind of veterans in the space, is that it makes our job really easy. So I can just go and sit and chill. She's done a fantastic context setting, so I don't think I have much to add. Nevertheless, we've prepared a short presentation, so I'll go through it. I'm sure everyone in this room at some point in time has heard about outcome-based financing. We are converts, we are skeptics, we are curious, and we are confused, and that pretty much sums up my personal sentiment on outcome-based financing at various moments in time. The one thing we can't do, it's like Marmite. You can hate it or you can love it, but given the current circumstances, we can't run away from this. So what we thought today is I could do a 30,000 feet overview of outcome-based financing, which talks about it more from a theoretical perspective in terms of the key principles. And then we've put together a fantastic panel, which will bring to life how we can actually apply these principles to solve some of our most pressing challenges through actual deals and transactions, and talk a little bit about their motivations in participating in outcome-based financing, but also hopefully inspire the skeptics to sort of convert and come over to this side of the room. And in all of this, I think the focus really is on unlocking domestic capital, whether commercial, whether philanthropic, whether CSR, different pools of capital, but really just getting domestic capital excited about the potential and promise of outcome-based financing. So that's really our session objective today. I'm going to start with the context setting. I'm going to skip about British Asian Trust. Prachi's very kindly introduced us. We pioneered this approach in South Asia, including in India, and we are right now in our third large transaction. We've mobilized close to around $40 million over the last 7 years, benefited around 4 million plus people through these deals. The heart of outcome-based financing is actually a very, very simple and powerful idea, that financing is linked to outcomes and not to inputs and activities. In traditional finance, like we all know, there's a donor, there's a funder, there's an investor whose intention is to do good. They come in with their capital, they hand it over to an implementation partner, not profit, for profit, doesn't matter. The partner goes and runs its activities. You construct a school, you construct a hospital, and we all hope that the end outcome, which is that children start attending schools and start learning in schools, or that levels of maternal mortality fall, magically happens. So that's been the traditional form of development financing for many, many years. Outcome-based financing very simply just turns this thing on its head. It basically says that I'm interested in an end outcome, and I will only pay if the end outcome is realized. So there's a meaningful link between money and outcomes. And like we all know, paisa bolta hai. So when it pinches, the fact that you're going to lose somebody in this equation is going to lose money or capital, our incentives align, and we all start gunning towards that same end outcome. So that's really the idea of outcome-based financing, as simple as that. Where it falls on your spectrum of impact capital is sits somewhere in the middle, of course, more towards the social returns or the impact side. A very quick sort of, and this is like, I think Prachi alluded to this, the difference between blended and outcome. Blended kind of broadens the mouth of the funnel. So like Prachi said, of course, development financing in India desperately needs more resources, and blended helps to kind of bring in more resources. And what outcome-based financing does is that it tries to flatten the slope of the funnel and make it into a cylinder, which means that you're making the money work harder and smarter, exactly like what Prachi said. So every dollar that goes in is actually translating to an equivalent amount of outcome. Again, a very simplistic sort of representation, and I think this is not meant to be either or. The true magic of blended finance, outcome-based finance happens when the two come together, and we will talk to the panel and hear about examples of how that has actually happened in real life. Very quickly, the four key principles of outcome-based financing, we've all heard of impact bonds and the sort of the poster boy for outcome-based financing, but outcome-based financing is so much more than impact bonds. And instead of getting fixated on tools, social success notes, impact guarantees, impact bonds, I thought I'll lift the conversation a little bit and talk about the ingredients. And you can feel free to mix these ingredients in whatever form and shape and in the proportions. And every time you will get a new recipe or a new dish, which will be customized to your taste, which is the beauty of this approach and which is sort of the potential of this approach, right? So first, like I said very clearly, a meaningful linkage to outcomes. Money has to be tied to outcomes. There is, I'd be hard pressed to kind of say what meaningful would be. That will be very, very contextual. But fair to say that it is not tokenistic. It really needs to kind of either be the carrot or the stick that you want it to be, right? So it can't be so low that, people are very happy to let go of it and not work harder to really kind of, achieve those outcomes. Again, it's on a spectrum. There is no real sort of point. I think everything can be linked to outputs, which would not be outcome-based financing. All money can be linked to outcomes, which hardly ever happens in real life. Not possible, not practical, too risky. Where you generally end up is somewhere in the middle of that spectrum, where you'll have mix of outputs and outcomes coming together, and money being tied to them in different ways. The structuring or the engineering of this is, like I said, up to the chef or up to the cook. So you can fix, you can pay per unit, you can pay your nominal cost, you can have a sliding scale, you can have a fixed scale. That's structuring. At the heart of this, the principle is money has to be meaningfully linked to outcomes. The second key one is actually verifiable outcomes, right? Measurable and verifiable outcomes. If you're going to link money to it, then of course you need to be able to articulate it, quantify it, measure it. Again, how you do it is up to you, right? So there are certain instruments, there are certain sectors like, say, for example, healthcare, right? If you have biomarkers, you may not need to do independent verifications or evaluations. There is trust in that data. There is trust that you can't fudge hemoglobin levels of your community. Generally in India, we work in a sort of a trust deficit environment as far as data is concerned. So mostly we will all kind of have independent verification of the outcomes. That gives more comfort to say, yes, these outcomes have actually been realized. And instruments like impact bonds take it a step further. So not only just have the outcomes been realized, but the outcomes have actually happened because of your intervention, which is the attribution conundrum, right? Because if an outcome funder is going to pay for it, I want to be sure that these outcomes have been a result of my intervention and are not something that would have just usually anyways happened, then why bother, right? So again, like I said, you can figure out based on your context and based on how you're applying the approach where you want to be on the spectrum. But it is important that verifiability is ensured. Whether it's done independently or not, again, is something left to the discretion of the parties in that transaction. The third one is basically how much of risk is the implementation partner taking. So this is the third key ingredient. If I go back to my previous slide, I said money only exchanges hands if outcomes are met. So of course the next logical question is, okay, so who pays for upfront implementation? Again, if you're a for-profit, you have the balance sheet, you can invest the working capital yourself. But most of the social enterprises and of course the non-profits don't really have either the capital or the risk appetite to do that, right? Like they just can't afford to lose this money. And that brings me to the other risk is to say, if the outcomes are not met, there's a huge reputation risk and financial risk, right? So how much of a cover does your implementation partner get from this kind of risk is your third key ingredient. In something like a pay-by-results contract, the implementation partner is bearing the risk. There is nobody else to give him that cover or her the cover. In an impact bond, which is at the other end, almost 100% of that risk is transferred from the implementation partner to the investor. So again, like I said, you figure out what works for you, you mix these ingredients in whatever form and shape, and you will get the recipe that you want. The last one, of course, is performance management. If you look at the evidence, if you look at the body of evidence, the studies, etc., that have been done on outcome-based financing, especially impact bonds, there's very clear research to show that the delta that you achieve on social returns or outcomes to a large extent is actually because of performance management. And performance management is massively different from project management, right? Performance management is basically a risk mitigation strategy where there is a hand-holding support available to all your implementation partners who are actually going to be working in a very target-driven environment to say, okay, I have to meet this target. I need the data to show me where I am. I need help to figure out how to solve some of the problems that I'm facing, right? So that I can achieve my outcomes. And that's performance management. Again, internal, external, done by somebody else, depends on the transaction, depends on the need of the sector you are in. Generally, we see a mix of both. So of course, the implementation partner as a prerequisite needs to have some level of performance management internally. If you need to augment it, strengthen it, bring in some very specific competencies, you partner with external organizations, right? I'm going to skip this, it's technical, but just the point I wanted to make on this is, again, mix the ingredients however you want, and then you sort of see the different instruments and what they mean in terms of rigor, in terms of practicality, in terms of resource intensiveness to set up some of this, right? So the last slide I think I have, again, sort of, reiterating the point Prachi made. Financing is now not new to India. We've had these transactions and many more. These are probably the larger ones or the first ones which are featured here. Impact bonds, social success notes, pay by results contract, impact guarantee, using different types of capital, right? So I think, it's sort of the existential question to say, does OBF work? I think we are long past that. We know it works in India, it works globally, right? I think the point is, again, how do you, all these transactions and the people behind these transactions are either in this hotel or in this room, which is great because it means that there is a great support community available, which is also sad because it's a tiny, tiny, tiny community, and I can literally see all the people in this room. So I think the intent is to grow this community, to use this as a very promising and powerful tool to really achieve the outcomes that we all sort of, are set out to achieve. And that's exactly what I'm going to ask my panel to do. So I'm going to now call my panel to the front. I'll just do quick introductions of everyone in the panel, and then we can just dive right into the discussion. So first I have Abhinav. Abhinav's the program manager at Michael and Susan Tell Foundation. He leads the blended finance projects for MSDF as a member of the India programs team. His expertise spans the foundation's core sectors, education and jobs and livelihoods. With over 16 years of experience across management consulting, education and banking, Abhinav empowers the foundation's partners to achieve growth, focus on outcomes, and leverage different forms of capital. Next, I'm going to invite Dhan. Dhan is head of social impact and philanthropy, India and Middle East region at UBS, and also heads social finance at the UBS Optimus Foundation. With a background in programs and impact measurement, she focuses on innovative results-based approaches to fund social initiatives. I'll next like to call upon Soumya. Soumya is director and board member of 361 Foundation, the CSR arm of 361, the erstwhile IFL Wealth and Asset Management Company. She has 26 years of experience in strategic corporate and individual philanthropy, working with multinational foundations and family offices. And last but not the least, we're going to call upon Tushar, the omnipresent, the omniscient, who was missing from there but is always there whenever we talk about blended finance. Tushar is a partner at the Blended Finance Company. Cool. The panelists here, the reason why they have decided to participate in outcome-based financing over and over again, despite all the pain and all the challenges we've faced, but also also what are the one or two benefits that they have seen by participating in this approach, right? And I think Prachi alluded to some of them, but let's hear in more concrete terms with examples what are the benefits. So I'm going to start with Dan. Then UBS Optimus has not only been part of transactions and deals as investors, but you've also invested a lot in building the market, building the ecosystem. Really want to understand what's in it for the foundation and why does the foundation really champion this approach?
Thanks, Anushree. And thanks everyone for turning up in large numbers. It's really great to see a room filled and folks standing at the back, I'm sorry, but really inspiring to see the turnout for this topic. We've been very, very intrigued. We've been the curious and definitely the ones to explore outcomes-based financing in a big way over the last 10 years. So a little bit about the foundation. We're the UBS Optimus Foundation. It's a 25-year-old foundation that has been working on improving lives of children and young people globally through grant making, of course, in initial years, but increasingly towards thinking about innovative finance, the use of different techniques to both bring in more as well as better funding to the social and environmental problems that we're seeking to address. So in terms of doing that and doing that effectively, we felt it almost a responsibility to start looking into the outcomes-based financing space in a serious way. The foundation that I described looks at applying or deploying funds from UBS, which is the world's largest global private wealth manager. So this is the corporate philanthropy of the firm. It also deploys capital from our clients. So we provide philanthropy advisory and services platform to clients of UBS, and we apply those funds to programs. And then we also deploy funds from strategic partners. Therefore, we have a responsibility to all of our partners and funders to make sure that the funds we're using deliver measurable impact. And OBF, or outcomes-based funding, has been a very logical way to achieve that. So for that reason, we found it compelling, and it was really nice to see your kind of a trip down memory lane to see your timeline. But we've been active in the Indian market in about half of the deals that Anushree described on that timeline. So we started with the first education development bond in India with Educate Girls. That was at a minimal scale, I'll say. We considered it a sort of pilot. It was our first foray into this space. We then scaled that up to participate in the Quality Education Development Impact Bond and Utkrisht Impact Bonds in education and health care respectively. And then most recently have come in on Lifted. Each time, the scale, the number of partners involved in the consortiums has increased and expanded. And for us, that has been a learning journey that has really convinced us of the power of this approach to financing. And so I would say maybe the three key reasons why we look at this very seriously have been one is, of course, the flexibility that this kind of financing provides to our implementing partners on the ground to deliver results regardless of the paths that they need to follow to those results. And those pathways may change over the course of implementation. You may come across operational roadblocks, and I think for implementing partners, it's very important to have the flexibility to respond to the situation in a way that is relevant at the time. So the flexibility that it has brought to projects, along with the transparency. And so when I was talking about measurable impact that we need to deliver, it's obviously a way to deliver that. I think, and these are of course reasons that many of our peers have seen and feel are compelling reasons to get involved. I think additionally to that, you talked about performance management, Anushree, and I think it is performance management that is a unique aspect of OBF because OBF structures necessitate a very strong performance management, and it is that commitment to a continuous process of learning and improvement that also makes this very interesting for us as funders who are looking for measurable impact on the ground. So it's really about driving outcomes, and this is a really effective way to get there.
Abhinav, I'll ask you this question next. Why is MSDF so keen and wedded to this sort of approach, despite the many, many arguments and fights that we've had across all these years? Every time we do an impact bond, we look at each other and say, not again. And then within 6 months, we're there doing it again and again and again. So what is it in this that keeps you sort of coming back to this way of working?
Thanks, Anushri, and as Dan mentioned, thanks for all the support, thanks for the presence over here, and thanks for keen interest in this topic. I'll start with where the name of the instrument itself is, the impact bond. It's impact at the center of it. Impact at the center of it and alignment on impact across various kind of funders. We've seen multiple different new kind of funders getting excited, whether it is CSR capital, whether it is domestic capital, and when that common alignment of impact happens, that's where the magic gets created. And that's the key reason that Foundation cares about impact in a measurable manner, in a way which is verifiable. All these principles align very well with outcome-based financing. Keeping impact at the core of it, making sure that everyone is working towards the same outcome, whether it is the service provider, whether it is the performance manager, or whether it is the risk investor or the outcome funder, pushing the implementation partners to do it. Everyone has impact at the center of it, and that's the key reason that we feel very strongly about these instruments. The second has been alluded to in Anushri's presentation, Dhan has also alluded to, but a strong performance culture has really helped us deliver more for the same amount of dollar. Prachi also mentioned that it helps blended finance and impact-based financing helps us go farther on the same amount of dollar, and we've seen those results across our instruments. So whether it is the lifted, whether it is the early results on lifted, or whether it is the results that have come in on QEI impact bond, we've seen outcomes which are 2 to 4 times the outcomes of our normal grant instruments. And this is with the same participants, just because there is a keen interest on performance, there is a key interest on learning from the mistakes that we've created, and there is capital available to learn from those mistakes and to re-implement that capital in an impact-based measurement. Last I would say that across the bonds or across the instruments that we've participated in, there has been constant innovation. Let me start with the QEI impact bond. The QEI impact bond built on the excellent work that the Educate Girls impact bond had done. Looked at the participants, how they can scale those interventions that they've already been doing and these are outstanding NGOs who've been there in the field. They've been doing that work on ground. It was more about scaling, more about focus on their performance, and how do they take it to the next level. That's what QEI innovated on. When we went to the skill impact bond, the real innovation was how do we get government and how do we get government to participate in an outcome-based instrument where government is also looking at outcomes in a similar manner that the philanthropic world was looking at. NSDC was very open at it. NSDC looked at it, co-designed it, I would say, through the nights, the fights that Anushri spoke about. They co-designed the entire instrument along with us, aligning on similar outcome matrix, and has participated in it. And now they're looking at more and more outcome-based instruments and how they can get more outcome-based capital behind such instruments. If I come to Lifted, Lifted had a unique problem that Lifted was giving you outcomes after 3 years. This is because these are indirect interventions. They are set up for foundation literacy and numeracy in government schools. But they are indirect interventions, not directly on the student. Hence, it will take some time to translate into learning outcomes. There we innovated around saying, how do we make it sustainable? In order to make it sustainable, we went one level behind. How do we measure outputs? These are outputs which are not easily measurable. So for example, is a meeting effective or not? Is the mentoring which is happening in the classroom effective or not? Outcome-based financing help us put a quantifiable, measurable way in measuring these outputs and making sure that if we are measuring it in that way, it becomes almost an habit in the system. And by the time that the impact bond ends, it should have become sustainable in the system, is the thought behind it.
Thanks, Abhinav. Outcome-based finance, right? And I think this, again, you're probably an exception or an outlier in the ecosystem because we haven't seen somebody so wholeheartedly sort of embrace this approach. So where does this come from and what really motivated you to embrace this? But also, how did you get the buy-in for this internally? Because I mean, either you were extremely lucky that your leadership was very progressive and empowered, or you would have had some really interesting conversations. So if you can give us a sneak peek into what happened internally, why did you adopt the approach, and how did you secure the buy-in, I think that would be super interesting.
Good afternoon, everyone. Just to set context, 361 was formerly IIFL Wealth and Asset Management, right? A lot of people in this room may not know 361. India's largest and only listed private wealth advisor and asset manager, with $64 billion of alternates-focused assets under management and about 8,000 ultra-high net worth individuals or families whose wealth we help manage. 361 Foundation, like Anushri said, new kid on the block, actually not as new as them, 3 years old. We set up the foundation just about 3 years ago, and our founding philosophies, we pioneered a more catalytic approach. We reimagined traditional grant giving, and we've pioneered a more catalytic approach to grant giving, solely powered by blended finance and outcome-based giving. To generate a much higher impact on our grants, or a much higher leverage rather on our grants, either by recycling capital, unlocking capital, co-funding, but all having a disproportionate focus on outcomes. So having said that, I think on this panel, I think to the best of my knowledge, we are the only domestic foundation doing this. So I think I would represent domestic capital, at least on this panel. Second thing I wanted to just point out in terms of context setting is we haven't had the luxury, the privilege, or the pain of taking part in any of these instruments up on the screen, right? I keep telling Anushri the next time I'll do an impact bond, count us in, or let us be in the skill impact bond. So we have not done any complicated, expensive instruments, so to say. Yet, in the past 3 years, we've completed 17 transactions and funded 2 knowledge assets or public goods with very, very, very modest, very humble resources. And all of them have had some form of blending. So whether it's philanthropic capital, commercial capital, government capital, all our transactions, all our 17 transactions have had a convergence or blending of capital. And all of them have been outcome focused. So many of them actually link payouts to the achievement of measured and verified outcomes, but all of them were designed with outcomes at heart. And from our 17 transactions, we've done a few returnable grants, we've done a few credit guarantees, but all of them have been measured by like a financial leverage ratio and an impact leverage ratio. So I was just kind of, the next 2 minutes when I tell you about examples, they're not going to be these complicated impact bonds, yet they're going to have embodied the philosophy or the culture behind OBF, right? So with that, I think in terms of business case or why we did it, efficiency and effectiveness of capital, right? So the first one, efficiency. If you have limited resources, the minute you start linking payments to the achievement of predefined measurable outcomes that have been independently verified, you're reducing the risk of funding programs that don't work. So it's almost it's a very logical decision that it's improving the efficiency of donor funding. In terms of effectiveness of program design, while there is an appropriate transfer of performance risk onto the implementing partner, underperformance actually provides an opportunity to course correct and to re-engineer, reimagine your delivery process and go back and correct it, or I would say optimize it till outcomes are achieved. And by doing that, the implementing partner is actually building a stronger program poised for scale and to attract future funding. So that effectiveness of the program is also hugely increased. So it's honestly, I think, been very much of a win-win for us, right? It's been kind of, you're incentivizing performance, you're increasing efficiency of funding, and you're increasing effectiveness of programs. So it hasn't honestly been it's been a win-win, and our brand's performance value has, or our brand's value and purpose is performance plus. So for the foundation to very naturally embrace kind of optimizing performance on social impact was a no-brainer. I also spent 10 years at GE, and Six Sigma is very much part of my DNA. So I don't know if that, you know, um, disposition towards process excellence and driving efficiency in processes helped or not, but it certainly might have been a contributing factor. But it's not, I think the business case was fairly simple. I would obviously have to thank the partners who were ready for the challenge. So I think convincing the board was one thing, but partners who, especially non-profit partners, who are willing to embark on this journey with you, I think wouldn't have been able to do it without them. In terms of, would you like me to give 2-3 quick examples, or do you want to, you're going to do example? Okay. So yeah, I think that I'll wrap up the business case. There were 2 examples I was going to share, but I can talk about that in the next round.
Kishore, I'm going to kind of throw googly to you. You do googlies extremely well. Is this as an approach, and maybe some of the instruments, from an investor perspective, right? Because what we've heard so far is very much focused on social returns and impact side of things. But from an investor perspective, what, I mean, like we saw, it kind of sits more towards the social return spectrum of things, right? But has the promise actually borne out, right? So people, investors, especially in instruments like SSN or impact bonds, have they seen returns? How should they think about it? Can you sort of hypothesize what their sort of motivation would be going into an instrument like this?
Yeah, no, thanks, Alisha. Interesting question. I think at some level, that side of the capital is almost easier. Right? The incentives for investors are known. When I talk about the folks here on the table, they all focus on impact. But again, if I were to ask them the definition of impact, it would probably look different. And not, I mean, hold the part, but would look different. And therefore, where investor entities have not been able to come in, we've seen almost sort of philanthropically owned investing entities playing a role there in helping essentially that set of a market. Not surprising, given that this is a fairly, relatively, I would say, early ecosystem. Yes, we've had a lot of experience, but I think we are already moving forward. We're already moving into constructs which are now aggregated like funds. Maybe the second element that I will touch upon is, which probably is at more complexity, is how do you even determine risk, right? And unpacking that, I think, has been, at least, you know, in my role, whenever I've worked on helping design or structure these transactions, has probably been the biggest element. How do you really look, you know, get a sense of risk in ecosystems where something like this has never been done before? Just to take an example of the skill impact bond, where a number of us are involved, there really isn't a lot of data which can tell you whether moving incentives to this and then pegging outcomes at a particular level is going to be able to, you know, we will be able to drive outcomes. What's the risk there? What sort of target should you think about? How do you price it? I think that pricing of the risk is probably the most important and complex element here. While there has been incredibly exciting, innovative work, but that is what very often is the crux of at least in my mind, whether an impact bond actually succeeds or falls apart. One is of course the upfront thinking around whether this is a good instrument fit, but I would say the second is whether you are able to really find elements that build up to what you define as risk. Do you have data? Do you want to be able to figure out what the risk there is? How do you price it? What sort of returns do you look for, and how do you?
So I think that's been a very neat segue into the next sort of round of questions, which I'm going to do with the panelists, which is around barriers. If this is really such a cool idea, if it is such a powerful idea, why aren't more people embracing it, right? Why is this entire community limited to this room? We're going to start with Dan, and we have a full house here. It would be a shame if we don't have time for audience interaction. So if we can just keep it very crisp, I think that will be super helpful. But Dan, over to you.
So I think in terms of barriers, actually there has been tremendous momentum around outcomes-based financing, and we support an alliance of Outcomes Finance Alliance and Accelerator program globally. We saw major commitments from donor agencies, bilats, multilats in 2019. What happened then in 2020 was COVID, and that actually created a huge roadblock. Everyone had to repurpose their funding, rethink. So even though financing strategies were being developed in-house, these all went on hold. So I think there's a geopolitical risk, general, emergencies, crisis kind of barrier that exists. I think the other one is mindset. This really involves a mindset shift. And so, when you talk about kind of behavior, I come from an implementation background, and we always talked about behavior change and behavior change communication in the field. And it's the same with outcomes funding for the funder community. It's about shifting our mindsets and it begins with a trajectory from knowledge, attitude, and then finally practice. I think it's a matter of time, but it will take time for that.
Abhinav?
I'll go a bit technical on that, and the reason being that all of these transactions have taken so long to get designed that some of people who are at the beginning of this lose interest by the time they get designed. So for these transactions to become more scalable, for more forms of capital to participate, I think a couple of barriers that we have to overcome are more on replicability, scalability, cost of the transactions, and making sure, as Dhan was mentioning, that more and more players in the ecosystem understand these transactions much better than what they currently do.
I have two, but I know you're going to remind me of the third one. So the first, little bit I think Dan touched upon it, but just misconceptions about use cases, right? So blended finance and OBF is not about complicated instruments, nor is it about one size fits all, right? So it's about the kind of problem that needs to be solved and the kind of capital needed. And it's not, OBF doesn't lend itself to say pilots or moonshot innovations. It's really a tool to scale proven models when there's sufficient evidence of outcome achievement. So, kind of that misconception about use cases. I will actually put regulatory restrictions under misconception, because if you ask me, as the only domestic CSR, or one of the very few domestic CSRs that have even tried to take part in OBF, when you're an outcome funder in an OBF transaction, not much is changing than a traditional grant, right? At the end of the day, your check is going to a CSR compliant entity. It is the theory of change or the objective is aligned with Schedule 7. You're getting a fund utilization certificate, you're getting an ATG. It is actually a multi-year program where outcomes are being proven versus a one-off project. So there's really no reason why, and I would say, like, most importantly, it's got impact at its heart, right? So not much has changed. I would almost flip the question around. It's not in the normal course of business. There is no return of capital. There is no ROI. There's no financial gain to the donor. So I would almost flip the question around as to why people think it's, compliance could be a hurdle. And the last one, real quick, is capacity and capability of implementing partners. I think, as all of us know in the room, a lot of nonprofits don't have the capability and capacities that are required. And that's in fact why we've actually invested in developing this self-diagnostic tool. 361 Foundation is supporting British Asia Trust, ATMA, and ISDM to build a tech tool that can help nonprofits self-assess their preparedness or readiness to be outcomes ready, and also signpost them to various resources or self-help resources that help them build capacity and strengthen their preparedness. So those would be my 3 points.
Tushar, very quickly, I know you alluded to sort of the imperfect reality of our context, right? Lack of data, lack of benchmarks, lack of price, etc. Anything else to add to that in terms of barrier?
Nothing much to add. I think others have already covered most of it. I think I'll very quickly add to two of the points that have already been spoken. I think what Dan said about the shifting mindset. It would be, we know that this is like seeding an ecosystem, that the investment made here is going to, and hopefully is going to then lead to a lot more capital coming in a different manner. So that is almost a funder side mental shift that needs to be made, because it will be, I think all of what we talk about, the time cost, all of that is because it is seeding an ecosystem, it's an innovative ecosystem. The real sort of hard barrier, I think, is what Sonia spoke about, which is how do we find implementing partners that are able to both absorb and scale. So that's the direction.
Then probably Tushar, starting that way, just rapid fire, two top sort of recommendations or strategies that you want to suggest to capital holders to consider outcome-based financing as part of their sort of investment or spending portfolio.
Number one, I would say to follow up on what I said about seeding the ecosystem, actually see it in that manner. See that as a process where you build on top of what you've already done, and then scale up ideas where you've already spent time and money and effort and all of that. So while I completely agree that the government and all are sustainable pathways, but if we can do that, so that's number one. The second, I would maybe something that was said in the plenary in the morning, if there's a way in which we can not try to move from 0 to 100, so not everything needs to be gold standard. Can we actually think about ways in which we are able to get comfortable with some of the aspects being still messy in a messy ecosystem and learn as we go forward?
Soumya?
Number one, keep it simple. I think I'll play off that last point. OBF does not need to be complicated instruments. It's not simple milestone-based funding, but it does not need to be a complicated instrument. It is a culture, it is a philosophy of continued learning and improvement. I think as Abhinav touched upon, it's just a unique delivery mechanism. You're re-innovating delivery to keep outcomes at the center, designing around it. You don't always need to have risk investment involved. You're basically making your philanthropic dollars work harder and smarter. So, if with modest resources, if we could have done 17 transactions in 3 years, my biggest recommendation would be keep it simple and embrace the philosophy, the underlying principle, which is linking payment to the achievement of outcomes. And the second one would be, I would have to say, getting more HNIs and family offices to participate. The social sector, the needs patient capital. The concessionality that grants provide because they don't have expect returns is a gold mine for the sector. So I think encouraging family offices and HNIs to participate, and of course in the same sentence I would say government. I think systemic integration. Most of public funds are still very input driven. So those would be my
Abhinav, 2 quick tips.
So, 2 tips very quickly. One, think about what you care about. Think about the impact that you want to drive. Don't think about the instrument first. If you start thinking instrument first, it will be very difficult to find a problem to solve. Think about the problem that you want to solve and then find the instrument that is right to solve that problem. Second, I would say that each type of capital has its own role to play. There is a risk continuum that exists. Commercial capital will be available beyond a particular risk-return profile. Identify which type of capital goes into which risk-return continuum. Where does the HNI capital play? Where does the CSR capital play? Where does the foundation capital play? And where does the commercial capital?
And lastly then, I think, of course, sort of, your recommendations for capital holders, but also if you can illustrate how you've brought together outcome-based financing and blended finance and, sort of done it in a very unique way. I think that also as an example would be super helpful.
Sure, happy to do. So I think in terms of just the tips, I'd say get started, which is kind of, I think, what the general consensus here. And so, start, like Anushi said, there's many ingredients and you can use them as you choose to build your own recipe. And I think for funders who are also interested in boosting the ecosystem, there are really capable and well-intentioned implementing partners and funders who are seeking support, resource, and expertise to get started. So funding to accelerate the ecosystem is important to do. I think in terms of just the example that Anushi was talking about, the way we've sort of brought blended finance and outcomes-based finance together, and they don't always go together, they are quite distinct, is that we did look at developing, and we have developed a pool of capital. It's a $100 million risk fund to finance outcomes-based projects. So it's a first of its kind blended fund that is looking at an underlying asset class of outcomes-based contracts, and in that manner, we are seeking to address both that funnel as well as the better use of that wider funding towards impact projects. So we've already made our first 9 investments through that initiative.
And with that, I think we will open the panel up for questions, reflections, suggestions from the audience. I think we have roughly 10 minutes. I'm trying to look for Varun. 10 minutes? Yes, we have roughly 10 minutes, so bring it on.
Where does the complication and expensive part come in these transactions? Like, could you elaborate on that?
Okay, let's take 3 and then we'll distribute. So yes, I see 2 hands here, and then so.
Yeah, my question is actually to all of you. First of all, congratulations for the excellent commentary by all of you. I would like to know more about it. Firstly, it's great to have UBS involved, bringing the capital that you can mobilize. I'm also interested in more about domestic capital mobilization of the philanthropic variety. And what do you think is the future scope for it? Are the philanthropists going to consider this type of funding? You've been doing it, congratulations. But what do you see, for the future for more domestic capital in this kind of asset class?
There's a question here, yes.
Hey, sorry, very new to the sector, so if it's basic, I apologize. Isn't there an inherent ethical hazard to putting in a social goal and attaching sort of quantitative metrics to it? For example, let's say I'm trying to ensure that there is hospital capacity for everybody in a particular place. If you stick efficiency percentages on it, do you then not incentivize the hospital to sort of put people into beds where they don't necessarily need to go into bed? So isn't there, if you're trying to solve a social problem, isn't there an ethical hazard to attaching sort of numerical objective to this?
We'll take one last question. I know you had one. So I'm going to take one last, get the panel to answer, and then if we have more time, we'll take more. Otherwise, we'll continue the conversation outside. Yes.
So I just wanted to ask if anyone here in the room is actually looking at nature-based solutions, climate adaptation for blended finance projects.
So 4 questions. I think first one was, where does the complexity and sort of the expensive nature of this creep in? Would you like to kind of take that, both of you?
So as Soumya was also mentioning, the instruments can be very simple as well. It's not necessarily that all instruments have to be complex. But particularly impact bonds have taken time, and the reason has been twofold. One is, as I said, alignment on impact. So the first reason that instruments typically take time to design is, Tushar was also alluding to this when he said that when I asked what is impact, while all of you might be saying the same thing, you'll say it a little differently. And getting that common alignment on what impact is, how do you measure it, how do you verify it, has been the reason that it takes time. Second, while cost to put together such transactions is high, because initially you need to design for it, there's a lot of legal work involved, because there are multiple forms of capital coming together, etc. However, at the same time, I will say that the impact more than enough covers for it. If you look at cost per impact or cost per outcome, cost dollar per outcome, that will be much less than what grant is able to achieve in an outcome-based instrument.
Anything to add? The second question I think Sir had was around how do we unlock domestic philanthropy for this, and for that I'm going to probably request Soumya and also Dan to sort of come in.
Yeah, I think so. To be perfectly honest, at least 361 Foundation's focus for the past 3 years has been to put our money where our mouth is and use our own 2%. to do these 17 transactions and get 3 years of data, of evidence, making products or making approaches that work. So, but having said that, we're today at a 6.3x leverage, which means for say 1 crore that I may have donated over the past 3 years, I have measured verified outcomes of 6.3 crores. So 10 crores, 63 crores. And that's a very powerful story to take to your clients. We have not proactively engaged with clients yet. But having said that, just through inorganic discussions, organic discussions with some clients, they've all been intrigued, they've all been curious, they've all been convinced. And we've had, without intent, 5 clients who have already kind of embraced blended finance on their own, or helped us, approached us to help structure an RG for them, or co-funded with us. So I would only imagine that, I can't say from track record, but I'd only imagine that it's a matter of getting an HNI or an ultra HNI to be aware of what this is and explaining to them in simple terms what we're talking about. And I cannot imagine them, and even with the 5 that we've managed to do in a short span of time without any intent, I can't imagine there to be too much resistance. It's more a matter of demystifying and using simple terms to explain what the intent is. So, but I have a feeling Dan might be in a better position to talk about kind of HNI giving and embracement.
Yeah, and I think, when you talk about funding and bringing domestic funding to this, there are 2 sides of the funding table here. So there is the outcome funding, and I think domestic, as Samya mentioned, CSR is now kind of very easily lends itself to this kind of funding, and I think that's less of the problem in terms of construct. I think the question could be around investments and the investor side, and there actually it remains to be seen whether there is actually the need to build an investor case, because again, whether or not there needs to be a risk transfer from the implementing partner to a risk investor, it's a feature. It could be, it's not a necessary feature, but it is a feature in certain instances, and there could be alternatives to having a risk investor. So for implementing organizations that don't have the balance sheet to fund this themselves, there could be alternative solutions to risk investment. But I do think in terms of getting domestic investors, and if you say investors in terms of commercial market return seeking investors to the table, it is going to be challenging. So I'm not sure that should be our main aspiration. Yeah.
Well, maybe I misunderstood the question.
I wasn't looking at commercial side of it, pure philanthropy, where you don't have to get commercial returns, attracting that kind of capital for these funds.
So philanthropy both on the CSR as well as on the ultra and high net worth philanthropists side of things, there is increasing interest and appetite, and it's possible to bring them in on this kind of
I'm going to have to answer the questions around perverse incentives, mixed incentives, and then probably Tushar, you can help wrap this up and take the question on application of outcome-based financing to climate and nature-based solutions. Enough?
So yes, while designing these instruments, we need to take care of perverse incentives. That's definitely a concern when you're designing such instruments, when you're designing what needs to be measured, and hence thought needs to be put around whether what you're measuring will enable gaming of the system, will enable something that will lead to people fraudulently coming around, or getting stats which are not relevant to the outcome that you care about. It's also somewhere, as Dhan mentioned, that you're looking at changing human behavior. When you're looking at changing human behavior, some of these are characteristics that will get built in. However, having said that, when you measure it, when you put a metric to it, and you put the right metric to it, and I stress on the word right. Right is very important over here, because if your metric is incorrect, it will definitely enable perverse incentives. But if you put the right metric to it, even hard social problems are measurable. You'll need to break it down into smaller steps. It can't be done in a single step. So for example, if you were referring to healthcare, if you're talking about healthcare, there have been outcome-based instruments which measures healthcare in a way how many footfalls are happening in a particular hospital system. And these footfalls are not necessarily created on their own. These footfalls are people who are falling ill and coming and seeking healthcare responses. So designing and applying the right metric is the most important, how you can work around perverse incentives.
I just maybe add a quick point on top of what Abhinav said? I think one of the things which is important to have also is to have a learning mechanism. So especially I think for the initial impact bonds, what has worked well, I would say, is that there has been a learning mechanism. The consortia has put in good sort of measurement systems, have figured out if something doesn't work, or if you know something else might be playing out compared to what was expected, and then to fix. So that allows for them to build and get better. So just to add that to what I said. I think on the last one, so with the caveat that what Abhinav was saying before around making sure we start from what is the need of that particular intervention and the kind of impact we are looking for before commenting on the instrument. If I were to just comment on the ecosystem interest, we've begun seeing some of that in nature-based solutions, climate, etc. While those and also those tend to be much simpler structure of the kind that Soumya was alluding to before. However, I feel like it's in the phase where we're still figuring out exactly what works and how can something like this be applied, especially given carbon markets and some of those benchmarks there. What is of looking at approaches of this. So there is interest, but I think it's in that discovery phase. Is my reflection.
Cool, and I think with that we will close this segment of the track. Thank you very much for my panelists for being so open and candid and being so lucid and articulate just after a post-lunch session. And an even bigger thank you to the audience for participating in something that is typically conceived as being very, very jargon-based and technical. So thanks everyone for this, and we'll move on to our next section. Thank you.